Hello everyone and welcome back to the channel. Today I'm diving deep into one of the most complex and fascinating companies here in Canada, Brookfield Corporation. This is a Canadian company that a lot of legendary investors are currently holding the stock, and it recently was at a new all-time high share price. This is the 6th largest position in Chuck Akre portfolio. This is the 2nd largest holding in Bill Ackman's portfolio. And this is the 3rd largest holding of Josh Terasov's portfolio. I personally own 330 shares of Brookfield Corporation in my registered account, and it is currently my 3rd largest position after Meta and Google as well. Brookfield just released its Q2 2025 earnings report this morning, and I'm going to break down the key numbers and go over Bruce Flatt letter to shareholders. I will also briefly cover the new 3-for-2 stock split that Brookfield just announced, and I'm finally going to tackle a topic that's essential for any investor considering this stock: how to evaluate a company like Brookfield. I will be using 2 different valuation methods in this video. First, I will use sum of the parts method, and then I will use my personal discounted future distributable earnings method to find the fair value of the stock based on different assumptions. Okay, let's start with the new earnings report and key numbers. Distributable earnings before realizations increased 13% to $1.3 billion or 80 cents per share. For Brookfield Corporation, the operations and financings are intertwined and complex. Distributable earnings is the most important metric, as free cash flow or regular earnings does not reflect the true underlying growth of the cash generated from various operations and financing activities of the company. 13% growth is great, but it is less than analyst expectations. So it's a little bit slowing down. So that's why the stock is not trading higher after the earnings report. They are actually sitting on a record $177 billion in deployable capital, and that's a massive war chest ready for new investments. Nick Goodman, president of Brookfield Corporation, said in the report that we had a strong financial performance in the 2nd quarter, supported by continued positive momentum across our core businesses and a significant increase in monetization activity. To date this year, we have had over $55 billion of asset monetization, diversified across asset class and geography, returning substantial capital to our investors at excellent returns. This was a major point of concern for a lot of investors in Brookfield, which was basically the implied value of assets on the balance sheet of the company. But as you can see, the track record of Brookfield in selling those assets for equal or higher values compared to what they have them on the balance sheet is the reason that I'm not worried about the future of Brookfield Corporation. Okay, President of Brookfield Corporation continued, with a record $177 billion of deployable capital and an increasingly constructive market backdrop, we are well positioned to capitalize on investment opportunities, drive a strong organic earnings growth, and deliver 15+ returns on a per share basis to our shareholders over the long term. Okay, the strength of the report came from several areas of their businesses. Their asset management business, Brookfield Asset Management, saw fee-related earnings jump 16% year over year, and distributable earnings were up 12%. Fundraising was also strong, with $22 billion raised in this quarter. The wealth solution business is also a significant growth driver, with insurance assets now at a staggering $135 billion. The other parts of the businesses were not as successful as asset management and wealth solutions. BEP or Brookfield Renewable Partners and BIP Brookfield Infrastructure Partners reported a slight growth in their distributable earnings, while BBU or Business Partners and BPG or Property Partners had reduction in their distributable earnings. Property Partners in particular is an area that Brookfield is trying to reduce its exposure to this part of the business. So reduction is not a surprise, but this is something to take a note of. They also announced a stock split in October. The board of directors approved a 3-for-2 stock split of outstanding Brookfield Corporation Class A limited voting shares. Brookfield Corporation is undertaking the stock split to ensure its shares remain accessible to individual shareholders and to improve the liquidity of the shares. The stock split will be implemented by way of a stock dividend, which will be payable on October 9, 2025 to shareholders of record at close of business on October 3, 2025. Okay, so each shareholder will receive 1/2 of a Class A share for each Brookfield Corporation Class A and Class B voting shares. So fractional shares will be paid in cash based on the closing price of shares on TSX on October 3rd, 2025. Okay, based on the manner in which the stock split will be implemented, no Canadian or US federal income tax is expected to be payable by shareholders, except in the case of cash received in lieu of fractional shares. For example, for myself, I have 330 shares of Brookfield Corporation. So after a stock split, I should receive close to 495 shares of Brookfield at a slightly lower price than the market value before the split. Overall, the stock split doesn't change my valuation of Brookfield Corporation, but it's always exciting for retail investors as it makes the stock more accessible and easier to buy or write options on. Okay. Now let's look at Bruce Flatt, the CEO of Brookfield Corporation letter to shareholders, which released this morning. Financial performance was strong in second quarter, supported by continued momentum across our core businesses and a significant pickup in transaction activity. Then he continued with a statement about overall market sentiment. Despite the multiple geopolitical issues and tariff turmoil, global equities reached new all-time highs, credit spreads tightened, and interest rates remain largely unchanged and are expected to start going down on short end soon. US economic data continue to be resilient in spite of fluid trade negotiations, and while the timing and outcomes still remain uncertain, our business continues to be largely unaffected. The relative calm and supportive posture of global markets led to an increase in monetization activity. Year to date, we sold over $55 billion of assets. Financing markets are also strong, enabling us to complete $94 billion of financing across the franchise this year. It seems Bruce Flatt is happy with market conditions and the position of Brookfield Corporation in terms of access to the capital. He then continued, "We announced the split of our shares on a 3-for-2 basis. While this action does not impact the underlying value of the corporation, it costs us virtually nothing to do and ensures our shares are accessible to a broad base of investors." Okay, now this is the part when Bruce Flatt responds to a lot of negative sentiment about the price of their assets on the balance sheet. Market sentiment is improving and is increasingly supportive for high-quality asset transactions. To date this year, we sold over $55 billion of assets across the business. Substantially all sales were at or above our carrying values, monetizing significant value for our clients at attractive returns. He then continued to mention specific transactions they had in the quarter and how profitable those transactions were. He then continued to talk about why they focus so much on insurance business at the moment. So this is Bruce Flatt's statements. "Today, we invest in insurance. The future is insurance financed investing. Our long-term plan is to further enhance the efficiency of our capital structure, thereby enhancing the returns we can earn on our equity without changing the risk profile of the business. This is being done by refocusing overall Brookfield as an investment-led insurance organization, using our large-scale capital base to back long-duration, low-risk insurance. On the asset side of the balance sheet, we remain focused on the same asset classes where we have proven best-in-the-class investment skills, which are ideally suited for insurance. To date, we have had two primary sources of capital, our balance sheet and institutional client capital in our asset management business. In our next evolution, we are focusing on balance sheet to back our growing insurance operations, meaning that our capital will increasingly come from individual investors via our insurance float. Using insurance float to invest is an original idea of Warren Buffett. We saw huge success by doing this type of investing from similar businesses like Fairfax Financial and Prem Watsa as well. So it seems Bruce Flatt is really doubling down on insurance business and using float to invest and grow capital. He then continues, "Today our $135 billion insurance float consists of largely long duration fixed rate annuities effective saving products sold to individuals, whereby we promise to pay an annual coupon of plus or minus 5% and repay the principal at the end of 7 to 15-year term. These policies are very low risk in nature, and we can use this float to invest in assets within the parameters set out by insurance regulators. He then continued to talk about AI factories and the role of Brookfield Corporation in growing demand for AI infrastructure. We are launching a strategy for development of AI infrastructure, including AI factories, as the next evolution of build-out of global economy. Over the next 5 years, this will create a new asset class within the overall infrastructure investment landscape, and with it drive the next evolution of our long-term plan to dominate the asset classes related to investment into backbone infrastructure. This started 30 years ago with real estate, moved to pipelines and electrical transmission lines, has recently led by renewable power, data centers, fiber lines, and telecom towers. AI infrastructure is the natural next frontier, providing the essential compute and power backbone for AI-driven global economy. We own and are working to assemble all pieces of our first 7 major AI compute sites, which will be built over the next 5 years and require around $200 billion of capital. These sites include 2 in Europe, which will scale to $40 billion, 2 in United States with cost upwards of $75 billion, 1 in United Kingdom for $20 billion, and 2 in Canada for close to $50 billion. These sites include power, data center shells, and the equipment to provide compute capacity to the industry leaders of artificial intelligence, governments, and corporates seeking compute capacity. This effort draws on the strength of our global operating teams in real estate, power, and infrastructure, each a global leader in its category. Okay. Next, Bruce Flatt discussed their partnership with big AI corporations around the world, companies like Google and Intel. For example, Brookfield and Google recently signed a hydro framework agreement to deliver up to 3,000 megawatts of homegrown energy in United States. Okay, this is Bruce Flatt's statements on this. To advance our AI factory build-outs, we are collaborating with a number of large technology firms. Our partners are providing us access to high-performance computing hardware as well as offtake agreements. Most of these groups are already major partners and therefore well known to us. This will enable us to deliver world-class compute capacity across all of our sites and position us as a key enabler of next-generation AI infrastructure. As technology companies with cloud computing, AI services, and semiconductor designers are increasingly in need of infrastructure operators like us to scale their innovations in the real world. In addition to large technology firms, we are also engaged in discussions with different governments and large enterprises seeking to access to our high-performance computes. Okay, overall, it seems the future of Brookfield Corporation is really bright, and they are signing new contracts for providing power and infrastructure for AI servers left and right. Here's the thing about Brookfield. Its complexity of the operations and financials is both a strength and a challenge. Brookfield Corporation is not just a company, it's a holding company that owns a collection of assets, including stakes in different subsidiaries. This is where some of the parts valuation comes in to understand what is the fair value of Brookfield. Some of the parts stock valuation or breakup analysis is a valuation method used to determine a company intrinsic value by valuing each of its individual businesses or segments separately and then summing those values. This approach is particularly useful for complex companies, conglomerates, or those with diverse business operations that might not be accurately valued by a single consolidated valuation method. The core idea behind sum of the parts method is the total value of the company should be equal to sum of the value of its distinct components if they were operate as standalone entities. Usually companies with diverse businesses trade at a conglomerate discount, meaning their market capitalization is less than the sum of what their individual parts would be worth. So sum of the parts analysis can help us to identify if such a discount exists. Since each segment might operate in a different industry with unique characteristics, you will need to choose the most suitable valuation method for each individual segment. Okay, let's start with the most significant piece of the Brookfield Corporation, which is Brookfield Asset Management. Brookfield Corporation owns a substantial stake in this asset management business. We can take the current market value of BAM and multiply it by Brookfield Corporation's ownership percentage and get our first component value. BAM market cap on TSX is around 140 billion Canadian dollar. Brookfield Corporation owns 73% of BAM, so this part of the business worth 98 billion Canadian dollar. Next, we have other publicly traded subsidiaries, Brookfield Renewable, Brookfield Infrastructure, and Brookfield Business Corporation. We will do the same calculation for each of these, taking their market caps and applying Brookfield Corporation ownership to find value attributions to Brookfield Corporation. Okay, BIP or Brookfield Infrastructure Partners market cap on TSX is around 19.4 billion Canadian dollar. Brookfield Corporation owns 27% of BIP, so this part of business worth 5.2 billion Canadian dollar. Brookfield Renewable Partner market cap on TSX is around 23 billion Canadian dollar. Brookfield Corporation owns 48% of this business. So this part of the business worth around 11.1 billion Canadian dollar. Finally, Business Partners or BBU market cap on TSX is around 4.9 billion Canadian dollar. Brookfield Corporation owns 64% of this business. So this part of business worth around 3.2 billion Canadian dollar. Now, what about the private stuff? This is where it gets a little bit more challenging, but the company provides us with some clues. Brookfield Corporation has a massive private investment portfolio, including its real estate and wealth solution businesses. We can look at the company's own reported values, segment earnings to estimate value of these private holdings. For property partners, they generated $872 million in the last year in distributable earnings. As this is a real estate business, I value this part of the business at a 15x or 14x multiple. So this part should worth around 18 billion Canadian dollar. For wealth solutions, they generated $1.6 billion in the last year in distributable earnings. I'm going to value this part of the business at 15x multiple. So this part of business should worth around 33 billion Canadian dollar. Okay. Finally, we need to account for any corporate level debt, which is around $15 billion. Usually the other debts of the business is non-recourse. Basically, it will be held by various subsidiaries. It's not be held by the corporation itself. We will subtract this from the total value of all individual parts. When we add it all up, we get a total intrinsic value for Brookfield Corporation, which is equal to 152 billion Canadian dollar. The current market cap of Brookfield Corporation is $142 billion. So we see that this intrinsic sum of the parts value is higher than the current market cap, suggesting that Brookfield stock is trading at a discount. The discount, in my opinion, is not huge, but it is around 7% discount. I'm also quickly going to evaluate Brookfield Corporation after this earnings report based on future distributable earnings model, based on three different scenarios. In the bear case, I considered a little bit margin compression, and I assumed the business can grow by only 12% in the short term, 10% in the midterm, and then 8% in the long term, and a terminal multiple of 16. For base case or normal case, I considered a little bit better growth in line with current growth of the business and a terminal multiple of 22, which seems like a normal multiple for Brookfield Corporation. And finally, in the bull case or best possible outcome, I consider business can grow by 16% in short term, 14% in midterm, and 12% in long term, and a terminal multiple of 28, which is a bull multiple for Brookfield Corporation. If I hit calculate, the software will give me some valuable information about the stock. Intrinsic value of the company is between 62 Canadian dollar in the bear case and 147 Canadian dollar in the bull case. And the fair value is 101 Canadian dollar for a 13% return, which compared to current share price of 91 Canadian dollar, it seems the stock is trades at 11% discount today, and it is a buy according to the model. As seen in the video, Brookfield was undervalued slightly in both sum of the parts and discounted future earnings model, but the discount is not huge. It's between 7% to 12%. There you are, guys. What do you think about Brookfield valuations today? Are you still buying or just holding the stock for now? If you found the video helpful, be sure to like and subscribe for more in-depth financial analysis videos. Thanks for watching, and I see you guys in the next video. Farewell.